The stock market might be giving you a false sense of security right now. And I have one number to show you, and it changes how you think about everything. So, there's a thing called the equity risk premium, and it's a boring name, but it's a very important idea. So, think of it like a tip at a restaurant. When you take a risk, like choosing a risky meal at a new place, you expect a bigger reward. And in investing, the equity risk premium is the extra reward that you're supposed to get for putting your money in stocks instead of just parking it in a safe bond. So the bigger the tip, the more you are getting paid for the risk that you are taking, right? Now, here is a problem. As of mid May 2026, historically since 1991, that tip has averaged 4.6%. And right now, it's at 2.7%. So that means that the stock market is paying you less of a reward for the risk that you are taking than almost any time in the last 20 years. And the Fed's own financial stability report flagged this exact thing. Let that sink in. You're accepting a smaller tip for a bigger risk. So, does this mean that the market crashes tomorrow? Nobody knows that. But what it does mean is the cushion is very thin right now. And if you're 50, 55, or 60 years old, a thin cushion matters a whole lot more than it does for a 30-year-old who has decades to recover. So, this is exactly why planners right now are talking about locking in bond deals above 4.5%, looking at international markets like Europe that are trading at a real discount, and then making sure that you're not more in stocks than your retirement timeline and your goals and objectives can handle. So you don't have to do anything dramatic. You just have to know this number exists and what it's telling you. Okay. Comment the word premium below, and I will share how this actually shows up in a real retirement planning conversation. Follow for more. Your news girlie is reading the Fed reports, so you don't have to.